Good day, everyone. My name is Kristen May Silapot, and this is my report on Management 5, Chapter 19. My topics are the following: translation in foreign currencies, recording transactions and court procedures for U.S. companies, translating foreign currencies financial statements, and lastly, translation methods. So, transactions in foreign currencies. A foreign currency transactions is a transaction that is denominated or requires settlement in a foreign currency. A foreign currency is a currency other than the functional currency of the entity. A functional currency is the main currency that a company conducts its business, as companies transact in many currencies but report their financial statements in one currency. The foreign currencies have to be translated into the functional currency. A foreign currency transaction is one that requires settlement, either payment or receipt in the foreign currency. When the exchange rate changes between the original purchase or sale transaction date and the settlement date, there is a gain or loss on the exchange. Whoever views the denominated currency, it is where currency transactions takes place, as the foreign currency takes the gain or loss. The foreign currency gain is recorded in the income section of the income statement, while the profit or loss is determined by taking all revenues and subtracting all expenses from both operating and non-operating activities. Companies that make many foreign currencies transactions may buy a forward currency contract to get a guaranteed rate. Businesses with few foreign currency transactions are more likely to convert currency on the spot or current rate. When a foreign currency transaction takes place, an exchange rate is used to translate one currency into another currency. For example, if the exchange rate of the US dollars to British pounds sterling is quoted as 0.77, it means that USD1 is worth GPB 0.77. So, ang foreign currency is need to translate to US dollar. For example, is 100 pesos equals $2 because 50 pesos equals to $1. Recording transactions. Anytime an importer has to pay for its equipment or merchandise in a foreign currency, it must trade its own currency for that of the exporter to make the payment. So, assume that Sundance Sky Lounge, a US company, imports skies from a French supplier for $5,000 and agrees to pay in euros when the exchange rate is $1.45 per euro. Sundance records the following in its books: debit purchase 7,250 and credit accounts payable 7,250. If Sundance pay immediately, there's no problem. But what happens if the exporter extend 30 days to credits to Sundance? If the rate changed to, say, $1,500 per euro by the time the pay was due, Sundance would record a final settlement as accounts payable 7,250, foreign exchange loss debit 250, and credit cash 7,500. The merchandise stays at the original value of 7,250, but there is difference between the dollar value of the account payable to the exporter, $7,250, and the actual number of dollars the importer must come up with to purchase the euros to pay the exporter of 7,500. The difference between two accounts is $250, which is the loss on foreign exchange and is always recognized in the income statement. The company that denominates the sale or purchase in the foreign currency, in this case is the importer, must recognize the gains and losses arising from currency transactions at the end of each accounting period, usually quarterly. In the example here, assume that the end of the quarter has arrived and Sundance has still not paid the French exporter. These guys continue to be valued at $7,250, but their payable has to be updated to the new exchange rate of $1,500 per euro. The journal entry would be debit foreign exchange loss 250 and credit accounts payable 250. The payable would now be worth $7,500. So, if settlement were made in the month following the end of the quarter and the exchange rate remained the same, the final entry would be accounts payable 7,500 and credit cash 7,500. If the U.S. company were an exporter and anticipated receiving foreign currency, the corresponding entries would be accounts receivable 7,250 debit and credit sales 7,250, debit cash 7,250, credit foreign exchange gain 250, and credit accounts receivable 7,250. In this case, a gain results because the company received more cash than if it had collected its money immediately. So next topic is correct procedures for U.S. companies. The procedures U.S. companies must follow to account for foreign currency transactions are found in Financial Accounting Standard Board Statement Number 52, Foreign Currency Transactions. And FASB is a guideline that requires American companies to record foreign exchange items on a balance sheet according to prevailing exchange rate. Adjustment for changes to market rates are only made when they affect the company's cash flow. It also requires to record the initial transactions at the spot exchange rate and effect on the transaction date and to record receivables and payables on subsequent balance sheet dates at the spot exchange rate on those dates. Any foreign exchange gains and losses that arise from carrying receivables or payables during a period in which the exchange rate changes are recognized in the income statements in that period. Next topic is translating foreign currency financial statements. Even though US-based multinational enterprise receives reports originally developed in a variety of different currencies, they eventually must end up with one set of financial statements in US dollars to help management and investors understand their worldwide activities in a common currency. The process of restating foreign currency financial statements into US dollars is called translation. The combination of all these translated financial statements into one is called consolidation. There are two steps process in US translations. First is companies recast foreign currency financial statement into statements consistent with US GAAP. This occurs because a US company with a subsidiary in Brazil, for example, must keep the books and records in Brazil according to Brazilian GAAP. For consolidation purposes, however, the resulting financial statements have to be issued according to US GAAP in format as well as content. An example of content, Brazil must require that inventories must be valued a certain way. For the US consolidated financial statements, however, inventories must be valued according to US, not Brazilian standards. So second is companies translate all foreign currency amounts into US dollars. Financial Accounting Standard Boards Statement number 52 describes how companies must translate their foreign currency financial statements into dollars. All U.S. companies, as well as foreign firms that list on a U.S. exchange, must use statement number 52. Second topic is translations methods. There are two methods: the current rate and temporal methods. Both standards allow companies to use either of two methods in the translation process. The current rate methods, also called the closing rate methods under IFRS, or temporal methods. The one that company choose depends on the functional currency of the foreign operations, which is the currency of the primary economic environment in which that entity operates. The current rate methods is a standard methods of currency translations that utilize the current market exchange rate. The current rate methods is most often used when the subsidiary company is fairly independent from the parent's activities, while the temporal methods, also known as historical methods, converts the currency of a foreign subsidiary into the currency of the parent company. This technique of foreign currency transactions is used when the local currency of the subsidiary is not the same as the currency of the parent company. For example, one of Coca-Cola's largest operations outside the United States is in Japan. Its primary economic environment is Japan and its functional currency is Japanese yen. So, if say the cash flows and expenses are primarily in the foreign operations currency, that is the functional currency. And if they are in the parent's currency, that is the functional currency. If the functional currency is that of the local operating environment, the company must use the current rate methods, which provides that it translates all assets and liabilities into current exchange rates, which is the spot exchange rate on the balance sheet date. If the functional currency, on the other hand, is the parent's currency, the multinational enterprise must use the temporal methods, which provides that only monetary assets like cash, marketable securities, and receivables, and liabilities are translated at the current exchange rate. So, that's all. Thank you.